Hey, it's Justin Harvey. Thanks for tuning in to the Anesthesia and Pain Management Success podcast. With APM Success, we take a close look at important topics pertaining to business, practice management, personal finance, and careers for anesthesiologists and pain management physicians. We work hard to take your critical questions straight to the experts. Thanks for listening. This week I'm doing another episode with my good friend and fellow financial advisor, Daniel Wrenne. Daniel also has a podcast, Finance for Physicians, so if you enjoy today's content and his discussion, definitely check that out. We're talking today about just some of the more crazy, ridiculous anecdotes that we've experienced in working with many physicians, helping them quarterback financial decisions or watching them perhaps not take our advice or just seeing unusual things happen, seeing poor decisions made. This is kind of like the blooper reel of personal finance, and they're all true stories. So it's going to be a little bit different today, but I hope you enjoyed today's episode. Thanks for tuning in. What's up, everybody? It's Justin Harvey. I'm here with my good friend, Daniel Wrenne. Daniel is a CFP, also focuses on financial planning for physicians. He's one of those guys that like to keep on speed dial whenever I run into something weird or strange or I need a second opinion. He's been focused on physician financial planning for a number of years, based out of Lexington, Kentucky. Dan, thanks for joining.
Yeah, good to be here.
And this is going to be another cross-posted episode. He has a podcast over at Finance for Physicians. If you haven't, please check it out. This podcast, APM Success, is certainly a partner and collaborator with the work that Dan is doing. Really excited to talk to Dan today. We're just going to share some war stories from the trenches of physician financial planning, some crazy things, some awesome things, some terrible things that I think, have a unique window into. So Dan, I'm excited to dive in today.
Yeah, this will definitely be fun.
And just recapping before this conversation, unfortunately, probably the best and juiciest stories we might not even be able to share just because of it's difficult to change the substantive facts enough to be able to preserve client confidentiality. So obviously, anything that we talk about today is going to do that in an appropriate manner. But I want to start off, there's some good, some bad, some ugly. Let's start off with the good. There's immense value frequently that comes from working with a financial advisor who understands the physician financial trajectory. Dan, I know you have like some really big wins, some capital W's in the win column. Tell me about some of the things that you've seen.
Yeah, we've had, as we were talking about before we started, we've had a lot of wins, but a lot of them have not been like knock it out of the park home runs. Like we get a lot of singles and doubles. And I think that's kind of a misconception sometimes. If you look at like what I would consider our most successful or balanced clients, a lot of them are just kind of hitting the singles and the doubles, and it's not very exciting or sexy or, headlining. But a lot of some of the wins that we have seen have been avoiding big old obvious errors,
And that the value of that, by the way, is not to be understated. Because between the errors that I've helped clients avoid, and I'm sure you have too, and the errors that we've witnessed, they're huge. They're 5-figure, 6-figure mistakes, sometimes more if they're the cumulative impact of them. And so it's important to not downplay that, I think.
Yeah. So we've had several, a lot of student loan kind of biggies. We've seen a lot of these are kind of tied in with the whole like avoiding errors. And so I had one specific example that comes to mind. I had some clients. The hospital was paying the student loan on their behalf, and so that's, I guess, a little bit of a risk there because there's a little bit of removed. It's removed from the client, and so the client was just like, it's getting taken care of. My hospital's taking care of it. It's fine. And so we happened to be, I don't even know why we were looking at the payments, but we happened to be digging into the payments. Maybe there was a red flag. I can't remember, but turns out that there was quite a few payments missing in the record of their payment history from the hospital. The numbers didn't add up. And so we dug in and verified through the hospital that the payments were actually made. And then the student loan servicer, I won't name, but it took them a year, probably forever, of calling and ultimately verified some of them, but not all of them. And the client basically got frustrated and tired of fighting it, which made me, it kind of boiled my blood a little bit, but we had to kind of let some of it go. But basically, they're like, we don't have record of those payments, and we're just not going to, deal with it. So I, I didn't. We got a few of them covered, but not all of them. So you got to keep an eye on your servicer, especially when a third party's paying.
100%. And honestly, I just tell people at this point, I've heard so many of those types of stories. I just tell people literally anytime you talk to a servicer, especially if PSLF is on the line, just record the call. Keep a bulletproof record and assume that something that you ask to happen is not going to happen and that you're going to need to prove it. And if you assume that and you go in with that sort of mindset, then you'll be protected. And, I can't, there's a handful of times that come immediately to mind where I was as a third party on the call with a loan servicer and my client, and we're trying to do something very basic that's part of how the plan functions to preserve PSLF. And the servicer, again and again and again, is instructing the client to make a decision, basically to remove themselves from a capped income-based payment plan to go onto an uncapped plan, which would cost them tens of thousands of dollars more in pursuit of PSLF. And the servicer is instructing them very factually, like, this is what you need to do if you want to move towards PSLF. It was wrong. It was 100% wrong. Had I not been on the phone, and frequently people deal with this, like, they talk to servicers who very matter-of-factly say, here's what you need to do. And it's the diametric opposite, unfortunately. And you said boils your blood earlier. That's how I feel. It's like,
yeah. Well, they're not working for the client, so you got to think about who's working for who and whose interest they're looking out for. And a lot of times it's just ignorance. I think we had another student loan story with well, this has been several actually. They just completely miscalculated the payment because it's income-based calculations, and so in those situations, in several, like I said, a few of them have been like several thousand per month under calculated. This is where it actually benefited the client, the errors, but several thousand per month in a few of these situations. So what the client was like, what in the world? Because we always are double checking the payments, and we raise the issue, and they're like, uh-oh. And so what we suggested to them is we're like, call the servicer and say that you just wanted to make sure there wasn't an error and what's going on. So they did that. And the servicer was like, no, it's correct. It's correct. And I'm like, okay, take note of that. Save all your documents. Because I double checked their documents too. Everything they submitted was legit. Like, I couldn't understand where the error came from. And so it was just a blatant error, I guess. And they called the servicer to try to make good with it. And they just said, no, it's not an error. And it favored the client by a ton. I had another one that was interesting. It tied into PSLF, but I guess it wasn't directly a PSLF issue. But this client got there was an error with their employer, and they overpaid them by $50,000 one year. And I don't know what happened. They were in training, so maybe it was just that they misclassified them as not in training. I'm not sure, but they knew that the error was happening in the moment, and so they were responsible and saved kind of the difference. But what happened is this kind of train wreck pursuit afterward is like, you get the PSLF income verification, then the PSLF payment completely wrong, and then the W-2s are wrong, and the tax returns wrong, and then it was just an absolute mess of a situation. And that one, unfortunately, was not, there wasn't really, we did as good as we could. They knew that the error was happening and brought up the issue. It took the employer just like 6 or 8 months to fix it, which is nuts. Yeah, that kind of stuff happens though.
Yeah, especially with these big health systems, it's like turning a cruise ship. And this is why I'm always beating the drum for independent physician practice. If you, as a doctor, go to a doctor whose job it is to make sure that that is happening the right way. I mean, obviously I'm biased here, but it doesn't take 6 months rather than running it up the flagpole at corporate.
And this was a big ship. Let's just say this is the biggest ship, basically.
Okay.
If you can.
Yeah, we like to not name names on this show because we don't want to hear from any lawyers, but you can read between the lines. Dan, I'm sure as an investment advisor yourself, you've run into situations where people have asked you, come with ideas. Hey, I'm thinking about opening a Robinhood account and trading GameStop or some other, we'll call them harebrained schemes or other things that perhaps might be riskier than one of your clients realize. Have you ever interacted with that?
Never. No, I think that's probably more like a daily kind of a thing. Not quite daily, but definitely weekly, where we're uh, hearing of things that are, I would call like ultra risky investment opportunities that maybe um, sometimes they're aware of the risk, other times they're just kind of not completely unaware of what sort of risk. But I would kind of categorize that as the ultra high risk, kind of bordering on gambling uh, sorts of deals that you see out there, and it could come in the form of like a business deal from your buddy, or like a really high risk stock play, or even like options and crazy call put strategies and that kind of thing. But that there's I've had several clients lose quite a bit of money. I've had a few make a little bit of money. I don't have any like home runs where people actually um, hit it big on the really ultra high risk sorts of situations. Um, but I've definitely had quite a few. I think you had a good one where you had a story of someone really losing quite a bit of money and that kind of thing.
Yeah, one of the first filters that I always implement when I'm doing investment due diligence is liquidity. Like if somebody wants to do something, how easily can we undo that investment? And if it's locked up for 6 months, a year, 5 years, 7 years, like some of these closely held like private equity or venture deals are, then we want to understand that. We want to make sure that we can afford to not do anything as this slowly goes to zero over a 5 year period. And one of my clients had, you know, brought to me a real estate deal where there was this somebody who was investing in improving and leasing up apartment buildings somewhere in the Southwest. My client says, "Hey, I'm interested in doing this. What do you think? 50K, 100K minimum." And that was a meaningful part. That's probably, 12 to 15% of their net worth at the time. And they were on the risk scale, I'd say they're probably a 3 on a scale of 1 to 10. And they were brought this deal actually by one of their very close friends whom they trusted, had gone to college with. And this friend had made a lot of money with this developer doing this strategy of improving these apartments and then leasing them up at higher rent rates, and then capturing that delta. And I told my client flat out, like, you're a 3 on a scale of 1 to 10. This is like a 34. It's not even on the scale. Like if yeah. And so just so you know kind of where this falls, because they didn't have that kind of understanding, and liquidity was a big part of it, and the fact that it was only one building was a big part of it. Like what if an asteroid hits the building or some other weird thing happens, or there's issues with mold, or I don't do a lot of like multifamily residential due diligence, but the liquidity thing alone was red flags for me. And so I talked them out of it. Now this buddy was talking to his other buddies, and I know there were some others that did decide to participate. And it was a deal that ended up really going south, and the market was moving against this type of residents in this geographic region, and they ended up losing significant amounts of money. Some of them, it was like a big chunk of their nest egg. And so this is a perfect situation where, and I don't usually run into these, but this is one that sticks out in my mind as talking somebody out of something that has low liquidity and ended up losing a lot of money and would have significantly impaired their
Mhm.
ability to retire.
Yeah, I think the key there is like a percentage of your net worth, I think is important. Like if you're gonna do the ultra high risk sorts of deals, you probably ought to limit it to a certain percentage of your investments or net worth. You also don't want it to, I don't think, like if I'm doing that kind of a deal, I would not want it to be at risk of tanking my retirement. Like it shouldn't, if it's a ultra high risk deal, it doesn't need to be like you rely on it for your goal to be hit. And then if you are going to do it too, you got to do the due diligence, like you said. So I run into a lot of people that aren't even, so I'm not like experts at deals. We're not, as financial planners, we're just kind of hole pokers, really. I mean, a lot of what we do is just kind of ask questions about what's been done so far. Have you done the due diligence, or whatever. But what I find is a lot of people are not able to be doing the due diligence themselves, and that's a kind of a red flag in itself. Is if you aren't able to understand the deal enough to know whether or not it's good, that's probably like you know that's a red flag in itself. You need to be able to understand um, the workings behind it.
I know that something that you and I have both done is looking at contracts for physicians. And I
Yeah.
love the contract landscape because it's a moment in time when you can do something that's like really exciting and that massively helps your financial picture potentially. I
Hmm.
know that I've actually heard stories that you've shared in the past about some wins that you had in that area. How do you approach uh, helping a physician look through a contract? And do you have any specific stories you can share?
Yeah, we typically almost always recommend like a contract attorney or contract consultant to review the contracts from the kind of legal perspective. So we're always, not always, almost always though, looking at the contract, but we look at it from a little bit of a different perspective. We're more looking at how it affects the plan and the compensation and the benefits and that kind of thing. Sometimes we'll spot stuff, but we're not as qualified to kind of like read into the legal language. But an example, so we just had one actually not too long ago, like the other day. The contract initial contract proposal for the client was you know X dollars salary, whatever it was, $300,000 base salary plus they were offering uh, a $75,000 student loan um, payment. I don't know what they called it, but basically a payment to for the student loan, that's like a stipend for the student loans or something along those lines. And when so I suggested that kind of caught my attention. The student loan stipend, first of all, because it was a 501c3 hospital. So I'm like, PSLF, we got to make sure this is not going to, because this client in particular, the payment's going to be very, very low the first year, or maybe second year too, especially with COVID forbearance. Like the first few months are going to be really low, $0 payments. And so it turns out we kind of looked into it a little bit more. So the rules for this particular hospital were that it had to be paid um, directly to the loan servicer, the stipend. And I think that they were going to do 25,000 a year for 3 years, maybe something like that. But they were going to require it have to be directly to the loan servicer for good reason, probably because they want to make sure it gets paid they want to make sure it's used for the purpose. Then we asked, can it get paid directly to the client? And they're like, yeah, we'll pay it directly to the client, but they need to verify payment of the loans for the equivalent amount. And so we're like, no, 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 that's not going to work. So just to clarify why that's a problem, basically with PSLF, like anything above the scheduled payment is like tossing money out the window. And in this situation, it was like tossing money out the window that you also get taxed on. So it was like, it would actually make this person, it would make him like worse off having this stipend than he would have been without it at all. And so I was like, I started by saying maybe, try to explain this to them, ask for some alternatives. And so they were having trouble getting traction. And ultimately, in this situation, I ended up just talking with the hospital executives myself. And I was like, here's how it works. It's basically like throwing money away. Can we restructure it? And I think this one's kind of very recent. I don't know what the outcome is. I think that they're going to work with it and readjust it. But um, I have a feeling that they'll make this one work. In some cases, so I've had that specific situation come up probably 5 or 6 times. In some cases, it's gotten to the point where I'm like, listen, you need to decline the bonus. Like straight up tell them, don't pay it to me because we tried all the options and they're just not hearing us. In the times I've had to do that, they finally were like, okay, something must be up. Like either this dude's lost his mind or maybe there's something. So because it's a budget neutral thing for them. Like it's not going to change their costs. They're just trying to make sure it goes to the right place. But in my experience, once they understand what the deal is, they're like, oh, okay, that doesn't make any sense. And that's like a $75,000 swing. I mean, that's straight up big time difference in impact for just one individual.
Yeah. Yeah, that's a great example. I think those student loan only payments from 501c3s always look at under a microscope. It's one of those things you kind of have to wonder why is this not part of the institutional intelligence to say we are like literally every doctor that works for us qualifies for PSLF. And so if there's an instance in which we can compensate them in a way that's not like directly to their loan servicer, that's probably beneficial. So anybody out there working for a 501c3, beware of this. I think that's a great point. Play out the ultimate conclusion of the math problem and understanding if you're on production, what do you need to do to hit certain targets to get a certain resulting compensation? Conversely, if you're on a salary or salary plus bonus, you're kind of capped out, and understanding what are you leaving on the table. And one of the really powerful things I've been able to do for some of my clients is help them understand if you're producing, we'll say $1 million of collections from your patients based on procedures you do through the year, and you're getting a salary of $250 plus maybe a $50,000 bonus if you hit a certain metric, that's $300,000 total, which is 30% of your collections. Now, I might also happen to know that perhaps a standard percentage of collections would be 40% or 42 or 45%. So if your compensation mechanism is a salary plus bonus and you're doing collections up in the 900, a million, 1.2 range, then you're going to be leaving money on the table based on how you're paid. So as you're negotiating, rather than saying, hey, I want a bigger salary, say, we can align incentives to say, the doctor makes more when the practice makes more, and you're operating on a percentage basis at this point. And that can be, I've had one client in particular where we changed this mechanism. We went from base plus bonus to percent of collections, and based on flat production, it was a $100,000 a year differential. So understanding that math problem and working it out based on the variables in your situation can be really powerful.
Yeah. The only thing I would kind of throw out in regards to that is kind of an alternative we've seen. Sometimes I guess people have super low tolerances for fluctuating compensation. And so I've seen it where they're kind of like too much in the sharing incentives realm for their taste. And they're like, I just want like a guaranteed compensation set up. And so, you can kind of sometimes request to shift back the other direction. Now, typically, the more you go that salary route, the less you end up making, but it is a more secure form of compensation. And some people prefer it, even knowing that they're forfeiting money. But there's a lot of complexities in the contracts there with physicians, especially now. Some institutions have kind of like standards. They're like, we will not change this no matter what, and there's no negotiating. And maybe there isn't, but it seems like in my experience, most of them are negotiable.
Yeah.
Even sometimes when they say they're not.
Yeah, absolutely. I'm thinking about, I've had some, I'll call them very qualitative, like having nothing to do with numbers types of conversations with clients that have been jarring, eye-opening, and really important. And I'm sure you've run into this with as many conversations as you've had too. The one that comes to mind, as far as the holy cow, I can't believe this never came up type of category, and you mentioned one that I want to hear in a minute, but I was sitting down with a client. It was one of our first handful of meetings. We were basically, I was doing the financial plan, and then we're kind of sitting down after we've crunched all the numbers, and the conversation basically starts like, what matters to you? What's important? Where are we going? Not only as, investors, but as people, as professionals, as a family, as spouses. And the husband, describes, well, I'd like to be retired by age 53, and I want a savings rate of X, and I want to make sure that this much is going into these types of accounts every year. And I feel like if we can be doing that, then I'm going to be feeling confident and good about life. And I'm just kind of looking at the wife. And this is one of these really fun dynamics, is you get to sort of ask the question of both spouses, and then, sort of create the space for the other spouse who's probably less financially literate and maybe they feel intimidated to even have a seat at the table in this conversation. So I turned to in this case, it was the wife, and said, well, how about you? Like, what's on your mind? Where do you want to go? And what do you envision life looking like? And she's starting to cry at this point. And she's like, I'm losing sleep. All I can think about is the fact that we just bought this house that costs $1.1 million. And we're not able to, get competitively priced life insurance. And I'm just terrified that my little boy and little girl that we're raising are going to grow up without a dad and that I'm not going to be able to afford this house and I'm going to be destitute. And that's all I can think about. And the husband is sort of like, his eyebrows are ratcheting up and up and up as she's sort of like unloading this significant emotional burden. And this is one of those things it really left a dent in my psyche, and never take this for granted that there's alignment between, husband and wife or whatever. I'm sure, Dan, you've probably experienced this with your own spouse. I know I do. That third party asking two people the same question and allowing the space for each of those people, each of those spouses, to answer the question honestly, sometimes it totally changes the paradigm in which you're functioning. And obviously at that point, we were able to talk about financial security, talk about risk control and insurance and how we wanted to address that. But had it not been for that conversation, it's easy to say, oh, okay, yeah, savings rate of X, let's do this and that. And maybe I would have talked about insurance just in the process of planning, but certainly not addressing the deep emotional distress that my client was going through, that I, as an advisor, that's critically important for me to understand, that I want to definitely, probably first, like, direct my attention to be able to make the client feel cared for and
Hmm.
understood.
And so then once you get your life insurance, you have to make sure the beneficiary arrangements stay good, right?
Yeah. Tell me about that.
Yeah. I had an interesting one at I early in my career, I worked for a big insurance company and selling life insurance. And um, we had this was not someone I worked directly with, but I was in the office when it happened because it kind of was a commotion. But this lady came in, middle aged lady, kind of like excited, uncomfortable but excited, and raising a little bit of commotion, and then goes into somebody's office, has a meeting, and then leaves. We're like, whoa, what happened? That was just awkward. It was weird. And so it turns out that that was the ex-spouse of the ex-husband's life insurance beneficiary. He had passed away in an ATV accident, forgotten to change the beneficiary on his life insurance. Ex-spouse coming in to collect on the $500,000 life insurance policy that she had known all along. Interestingly, this was the kind of interesting. Potentially, like, you're skeptical. You're like, "Whether was she involved in the ATV accident?" But the husband had gotten divorced. He had forgotten to change the beneficiary on his life insurance policy and had died in an ATV accident. Ex-spouse coming in to collect on the life insurance, basically. And she's going to get it. Like, there's nothing you can do. So we were so curious. We're like, what about the current spouse? And of course, he was married, had children. We're like, oh my gosh, it was like worst case of everything scenario. But insurance company will pay the ex-spouse if they're listed as the beneficiary. Doesn't matter what should have been done or what the right thing to do was. They're going to pay what the beneficiary designation says. And so you have to be careful with that. I've seen ex-spouses, I've seen parents still while you're married. I've seen children, one child named when it should have been, all the children. I've seen the guardian named. That's a little risky. People are not sure. They don't want to name the children because they don't want them to get such a large sum of money. But then, so they're like, I'll name the guardian. But the problem with that is guardian can do whatever they want with the money. So you have to be careful with who you name as beneficiary and keep an eye on it every so often.
Yeah.
The moral
One
of
of
the
those
story.
things is like annoying administrative stuff that doesn't matter. It's not a big deal until it's a huge deal and it's too late.
Right. That's
And
a
definitely warrants, periodic, just checking the temperature, making sure, okay, here's what we got listed. Is this still, and this is part of my sort of annual review. I'm sure it is for you too, Dan. Like, trying to prevent that essentially. And especially if there's a divorce that happens, if there's a kid that's born, like, keeping everything up to date and never letting it go too long before asking
mhm.
those questions.
Yeah. We've seen a
Um,
lot of house. I think the house, we were sharing some of our stories of, I guess this is more of like avoiding some mistakes with house purchases and that sort of thing. I, for whatever reason, maybe that's just across everyone, but that seems to be a common one run across regularly in our practice. Is that true with you?
It is true, especially for the early career. I just finished training. I'm moving across the country to take my first job, and I want to go from, paying $900 a month in rent to, a $6,000 a month mortgage in some cases. It's a transition and one that should be navigated intelligently.
Well, but you can see on the one side, it's like, um, I've rented. So I've been renting for years and years, and I've been in training for years, and I've just now finally, like, finishing. and I'm tired of renting because it's not as, it stinks to rent. Like, and you got to move and it's not your place. And you're like, finally, I have the money, and you're going to have to make plenty of money. It's like, finally, I have the money to buy a nice place. And so if I'm going to do it, I'm going to do it right. And I'm going to find the right place. And so that's all kind of the psychology going into it, which is makes a lot of sense. But it gets all crunched up. It's like the timing is just terrible. It's like everything happens in like a month almost. It's like you finish, you move, especially when you're moving, it just adds to it. And you got to look for a house. It's difficult to qualify because you have tight finances sometimes. And then you pull the trigger on a house that you're not 100% sure is in the right area, in a practice that you're not 100% sure is going to work out. And there's just a lot of risk there in that decision. So naturally, that's where a lot of mistakes happen.
Yeah, I mean, and anybody who bought a house in like the 2005 to 2007 range, I know you probably know some people like this, Dan, and I do too, that that was a time when the time of the ninja loan, the no income, no job application, where you don't even have to prove to the bank you make money. They'll give you 100% of the purchase price of a house. Exactly. And in some cases, probably, I bet there have been mortgages awarded to dead people, so maybe not even. And that ended badly for people in that. I mean, imagine you're a physician who's finishing training, you buy a house in 2007, and for whatever reason, your group gets acquired, it doesn't work out, you're not on the partner track anymore, and you want to move. Now the house that you bought for $800K is worth $550, and you've got an $800,000 mortgage on it, so you need to cut a check for $250,000 in order to get out from under it. That is quite onerous.
I think that is the younger group, because that's been a while, I guess. Like, it's been a while since 2008. 2008 was the last like big time real estate tank, and everything went down in pretty much all areas of the country a lot, and in certain areas it went way down, like Las Vegas, like some of the touristy areas in Florida had big hits, like 50% plus price real estate price reductions. And I had one client in particular that they were in training in Florida, and bought their house probably like zero down, zero anything, pulse, you're good. Um, and got the house just for training. So, and then they go into practice and move, and they're finishing in like 2008. Bad timing, but 2008 timeframe. And so their house price basically had gone down by 50%. So like $300,000 house is worth 150. So so they financed 100% of it. So their mortgage at that time is probably like 280 or something. So, or 290 maybe even. So they owe 290 on a house that is now worth 150. And they're finishing training. It's like, and they don't have the resources. They're like, what do we do about that? So in order for them to sell it, they'd have to write a check for the difference. They're upside down, basically. So what they had to do, they had no choice. Basically, they had to keep it, and it is a rental house. You saw a lot of those in like the 2008 through 2014 timeframe. Is like the forced landlords. There was a ton of people that had like one or two rental houses because they were just like, and sometimes they would be like, yeah, I wanted to get in the real estate business, but but really, you peel back the layers, it was like they made a little bit of a poor decision and ended up in a house that they couldn't get rid of. And so they were landlords on that house. And I was working with them in my old firm. I don't know if the last time I talked to them, they still had the rental house and had not quite, and this is like 5 years into practice. And because that's a big nut to crack there. And it took a while for real estate prices to rebound. But I guess the moral of the story is housing prices do go down sometimes, even in areas that have very appealing metrics, like even in areas you don't expect them to go down.
Yeah.
And sometimes by a whole lot.
Yeah. And right now it's very geographically dependent. We're still understanding what COVID means, but there's definitely been a flight from, at least at a high level, high tax jurisdictions. Yeah, in big cities. If I could work from home and not have to deal with the 9% New York, state tax or whatever, and that's been a big shift that it's playing out in real time. So this, although 2008 feels like a long time ago, there's different versions of this in different geographies that can be any given person's specific problem. One other thing, Dan, that I wanted to cover, and I'm curious in your thoughts. I'm interested to hear about a time when your client taught you something, either like financially or something about life. And I have one, you can think about it. I had one instance that sticks in my brain. I was really lucky when I first started my career to work with many people who make many millions of dollars, what we would call ultra high net worth. And by some funny circumstance, the totem pole on which I was at the bottom, my boss couldn't go and my manager couldn't go to this meeting with this client. So I ended up getting in the taxi and going down to the law office in Center City here in Philly and sitting in with this estate attorney and our big shot baller entrepreneur client who's probably got like a $90 million business. And the estate attorney was this old, gray fox type who's like, oh yeah, we do this all the time. Like we'll break up the LLC. We're going to give a part of it to your wife, a part of it to your kids, put it all in trust. We'll have like the minority discount applied, basically reducing the face value of the components of the business. And then we'll shove it into this trust. And this is going to be this great tax move. And we'll get a 30% discount versus sticker. And it'll save you $7 million or some sort of whatever. And so I'm sitting there with my client and I'm in my suit. This is like my first meeting with a real human, basically.
When you wore suits.
Yeah, that's right. Remember that when we were in a conference room with other people?
Crazy.
And then the lawyer gets up and he's got to go use the bathroom and the client turns to me, and this is really my boss's client, not mine. And he's like, Justin, I hope you're paying attention. Like, this lawyer has no skin in the game. He doesn't care if this works or not. He wants to get a fee for creating a complicated legal strategy that I can't understand. And he's, this lawyer's 71 years old, and if this doesn't work in 20 years, he's not going to know or care. But I'm going to have to deal with it. And it was this, for me, like a real, this was 11 years ago now, and it left a dent in my brain to say, like, let's understand, follow the money, understand the incentive, and understand the stakes. Like, who's going to deal with the consequences of any given decision? This is really true in finances. Like, if something goes wrong, is this advisor, is this person who is giving you a certain piece of advice, or even a friend giving career advice or whatever, are they going to have to help you deal with the consequences? Or are they just telling you what you think in some sort of like complicated, sophisticated way that you can't understand? I think this is really true in finances. And I respected this entrepreneur who built this business from the ground up. And he basically was a multi-millionaire, multi-deca millionaire because of this instinct. Like if he didn't understand it, he didn't want to do it because he knew he would have to deal with the consequences. And this is true in like tax planning and some more advanced insurance stuff and pensions. And there's a lot of advanced financial planning ideas out there. And if you as a practice owner, as a business owner, if you're getting pitched something and it doesn't feel right in your gut, this is my instinct too, Dan, is like, I have to just say, like, I'm not into that. And it's okay. And even if it's technically correct, even if everything that lawyer said could have worked, that it could have saved $7 million in taxes, like, I don't like the risk that introduces to my life and the stress associated with it. And I'm not going to go there.
I would have to say I have not been gifted with that natural ability to sniff out that sort of thing. That's been something I've had to work towards is kind of gravitating to. I'm prone to the shiny object, like, naturally, and so I've had to work on getting better at the understanding aspect and not doing something until it's fully understood. It's easier almost to do it with clients for me in my planning work than it is my own stuff. That's just kind of the psychology, I think, in when you're in that role, is because I feel a higher pressure load to it's their stuff instead of mine. I'm just a high risk kind of a dude as well. So I'll kind of roll with some exciting ideas and try them out sometimes, especially personally. It's just kind of fun for me, but I completely agree with that, like in principle, and that you have to, it's safer, especially when you're not experienced with things, to default to no is my answer always, unless I completely understand it. If I don't understand it, if I can't explain it to my buddy, you got to say no until you understand it. That's true with business deals, with whole life insurance, like all this life insurance, complicated investment deals people try to sell. Like it's difficult. Like it's hard for us to understand it. Like, and we're dealing with them regularly. And if you can't understand it, or if I can't explain it to you, you need to probably just default to saying no, because that's what the whole point of this whole conversation is. It's like it's not the people that are knocking it out of the park with a deal that their buddy brought to him. It's the people that are hitting like doubles and singles and avoiding the deal from that looks suspicious. It's the people that are avoiding the mistakes that are really coming out ahead, I think, in the long run. It's like playing tennis, like you play with it. I'm not great at tennis, but like I play with like a grandpa and he's like whooping my butt just because I can't keep the daggone ball and they're just hitting it right. So I make all these crazy errors because I'm trying to like hit it so hard. But it's about minimizing errors.
Yeah. Especially in the, pretty much everybody who's listening to this podcast, many are going to have probably a couple degrees and they're going to be pretty intelligent and are going to be making a good income. And I'd say that's absolutely true. Is if you can minimize the unforced errors, as you astutely pointed out, then you're going to do very well. And there's a lot of benefit to taking this principle. Like, if I can't understand it, I'm pretty smart at baseline. And if even, especially if my trusted advisor can't explain it to me in a way that I understand, or if they explain it and it doesn't feel right in my gut, this is me. I'm a gut kind of guy. I say, like, jam all the information into your brain, process it, and then make a decision from your gut based on the things that you know. And I saw that in this entrepreneur 11 years ago, and it's something that I feel very strongly as something I want to impart to my current clients and also people listening to this podcast. Like, I think this is just Justin talking. This is my personal philosophy, but I think that will seldom let you down. And if you find yourself stepping out into things that you don't understand, you're more likely to get blown up in a way that you couldn't foresee.
Mm-hmm. Now you have to proactively increase your understanding too. So you got to be careful not to end up with like a big old bucket of cash just because your paralysis analysis. So all this stuff's a balance, like at some point you got to kind of take a little bit of a risk and step out and, um, but like I said, like all these stories I can think of are very much, just kind of like, ignorant mistakes and, easy to avoid if you really kind of take a step back and, look at it.
Yeah. So let's wrap it up. This has been really fun, just rehashing some of these stories.
Yeah.
I think like understanding. Oh, actually, there's one last one, the CPA one. Did you talk
Oh
about that
yeah.
already?
No,
I think
I
this is a
didn't.
good one to wrap it up on.
This is a good one because it's like my ignorance. So, like I said, I was getting into it. I've kind of had to learn a lot of these things the hard way. Uh, I think a lesson I've learned over time is I don't know much. I don't know as much as I've had to kind of run into brick walls and that sort of thing. So, with a CPA, so I was an independent contractor in early career, like 10 or 15 years ago, that kind of time frame, and had, taxes were pretty complicated then. And so I hired a CPA, and it was actually somebody that was referred to me by several other advisors that I was buddies with and worked with him for a few years. He was very inexpensive. It was like I was telling Justin, like a couple $100 a year for my taxes that were actually pretty complicated. I think at the time I thought they were simple. I'm like, I could do this myself because I was an ego young guy, didn't know what I was talking about. But in reality, looking back, they were actually pretty complicated. He did them for a few years. Um, for whatever reasons, maybe it was just gut or whatever. I ended up just stopping working with him and hired a different accountant. And I got audited like the year after that, and it was a big audit. Like they really dug into my stuff. It was painful. I learned a lot of good things about how audits work. That's but they dug into everything. Like it was months and months and months of audit. Uh, and it worked out okay. Like there was not any too bad of negative. I ended up having to write a check for $1,500. Turns out the issue was an error that accountant made with how they did the tax return. I'm not going to go into the error, but there was an error. That was the first issue. Second issue, that accountant ended up getting in trouble for stealing some money from another client shortly thereafter, a year or so after that. So I'm like, thank goodness I stopped working with that accountant. Fast forward a few years from there, he gets into some major stuff like drugs and prostitution, and so I think that they're in jail now, probably. But what's so crazy about that story is, so like my first accountant is, I think, in jail now, um, which is ridiculous. But first of all, everything kind of checked out, but there was a few red flags. So it was too inexpensive. Like it was very, very low cost. Um, that was a little bit of a red flag. And then my gut started to go, like going with Justin's gut. It didn't feel right. I met at his house. That was a little strange. And this was in the time when everybody had offices and met kind of in conference rooms. I would go to his house. There was a few other sketch things that I'm not going to say because it just will incriminate. But there was a few other red flags. But basically, moral of the story is, sometimes it's worthwhile to go with like a bigger firm. Get a good accountant, I guess is the moral story. Like if you're gonna do your taxes on TurboTax, or get a good accountant. And it's worthwhile to pay a fair fee for a good service provider. And sometimes there's some value in like having a little bit of a firm presence. Like don't work with, I mean, it's okay to work with a mom and pop, but like there's a little bit of risk there built in that it's like out of somebody's home. And I had to learn that the hard way. I only ended up having, an audit and a check to write, but, you never know how things play out.
So there's a lot of mistakes to be made out there.
Yeah.
And go with your gut if things don't make sense. If your accountant is too cheap, if you don't understand a complicated strategy your advisor or your lawyer is explaining to you, if any of this is going on, get a second opinion, get outside help. Understand that, especially as an attending physician, especially if you're a business owner or practice owning physician, like the mistakes get really expensive. And an error that a CPA makes, instead of a $1,500 check, it could be much, much more than that. And I've seen big 5 and 6 figure tax errors. So I guess that's the point of today's conversation, is just to give you some context for all the different landmines out there. And if you see yourself as a do-it-yourselfer, great. You need to be very engaged. And there's still some professionals that you need to collaborate closely with. But if you think that this feels very uncomfortable and you think that you might step on one of those landmines, frankly, it's the ones that you don't know that are there that are going to blow you up. So even if you don't think you will, you might. But qualified help, I'm just such a big, obviously I'm biased in this, but I'm such a big proponent of, if you make enough to engage for a luxury service. I mean, my clients, by and large, don't paint their house and don't cut their grass. And I think that handling the tasks and strategies associated with their personal finances in a way that keeps them engaged but not having to enact it themselves it's so worth it.
Yeah. And that's what a lot of our day job is doing. But like Justin was saying, everybody's different. So you kind of got to take this into consideration with your situation. And that's part of the fun part about it, is it's always evolving too. Everybody's situation changes, and sometimes you got to be like me and just sometimes you got to learn the hard way and make some mistakes and run into brick walls. And but if you make the mistake, just make sure to learn from it. Like that's the key. The worst is to have to be making recurring mistakes. That's just no good.
Well, Dan, it's been a pleasure speaking with you today. Thanks for joining.
Yeah, good fun always.
If you liked what you heard this week, head on over to apmsuccess.com, where you can find more content and free resources to help you build a successful career in anesthesia and pain management. If you wanted to leave a review in iTunes, I'd also really appreciate it. Thanks for using some of your valuable time to join me today on APM Success.